are we underestimating, are the equity markets in particular underestimating the potential effect of coronavirus?
The reaction from the equity markets has been really quite stark and extraordinary, because if you think back to what happened with SARS, you had quite a significant drawdown in the equity markets. What you've had this time round has barely been 1 week of drawdown, of reaction, before the markets bounce back. And what's doubly significant is not only is the coronavirus still considerably unknown in terms of its bigger economic impact and human toll, but of course China these days is dramatically more important for the global economy and for most Western companies than it was in the time of SARS. So very stark difference, and in my view there's an awful lot of correction yet left to come.
So, Seema, what are you hearing from investors? How are they looking at this? I mean, is this driven largely by liquidity in the marketplace where people aren't thinking about it? Or are they taking a hard look and saying, we think it's not that bad?
Well, I think, look, a lot of our clients are long-term investors. We're long-term investors. We are clearly talking about this with our clients, about the coronavirus. It's top of mind. But we're sort of still in wait-and-see mode, I think. I think we are. Even Apple said this, that production started to come back on slowly. Our thought is just still that into March we could be back to capacity. It's true that in the tech supply chain, where China has become a much larger part of business for a lot of technology companies. I mean, 80% of assembly now happens in China. 65% of components are produced in China. But I think it's too early to tell, and that's what we're talking with our clients about.
Do you have any sense about who's hit worse and who's hit less badly? I mean, for example, tech, as you mentioned, Apple, but also chip makers and things have really been hit.
Yep.
We also have retail reports, that are mixed, frankly. Walmart's saying we're worried about it. Puma got killed, basically. So who's getting hit worse and not so much?
One of the very interesting things that's happened as a result of the US-China trade war is that many large C-suites and companies have been forced to significantly reassess their supply chains. They weren't paying that much attention necessarily to the minutiae of that before a couple of years back. So some of them have actually built in more flexibility than is immediately visible to the outside eye, and that may be shielding some of them. Walmart surprisingly said it didn't think there was going to be any significant hit. However, we have story, with Puma and Adidas basically having quite a big hit in terms of where they're feeling the pain right now. And I suspect we're going to see more companies coming out, particularly those with big China-based sales operations, and saying it's hurting their earnings.
What about Seema? Are there some areas that you're more concerned about, some not so much?
I would agree with Gillian. I think retail, apparel, and semiconductors, really are the prime ones that we're looking at.
And perhaps travel.
And
I mean, if you take a look at airlines, you take a look at hotels, you take a look at, goodness knows, cruise ships.
Oh, exactly. The whole consumer area is something, we clearly have to watch out for. But again, a lot of China's economy now is driven by local demand and consumer demand there. So when you think about the impact globally, I would say, again, I think it's still too early to tell about the impact globally. Clearly for the Chinese economy, it's a significant issue.
I mean, the bigger question is, why are stock markets so buoyant and seemingly so completely impervious to any kind of shocks? And a lot of that's to do with the fact that it really is the central bankers who are the only game in town, to quote Mohamed El-Erian all those years ago. And insofar as things like the coronavirus are leaving investors thinking, actually, central banks are going to leave rates lower for longer, that's actually boosting equity markets. So you have this phenomenon whereby bad news is actually turning out to be good news for equity and bond prices.
Well, I think, we've read about that China is ready and prepared to implement fiscal easing. We have monetary easing everywhere. So I think the market's reacting to that as well, knowing that China is ready to step up and do what they need to do.
If in doubt, just chuck a bit more fuel on the fire and keep it going. That's basically the mantra.
As long as it keeps going, as long as the music keeps playing. If it stops, that raises some real challenges.
Exactly. There's no signs of anybody actually thinking what might happen when it will stop right now, or any sign that central bankers are willing to stop.
But if it's central bank stimulus that's really supporting this, Seema, how as an investor do you draw distinctions between good investments and not so good investments? Because, it's sort of that rising tide effect.
Right. So a lot of what we talk about are franchises and owning franchise businesses that can navigate you through the noise, and this could be loud noise and longer term noise, we'll see. But clearly, again, when you think out investing over 10, 15, 20 years, the focus we like to have is on franchise businesses globally.
But that's a polite way of saying we're trying to get into the business of zombie spotting, zombie screening, and trying to work out, which businesses and sectors are essentially being kept alive longer than they should be by this tidal wave of cheap money.
But don't we need to do exactly that to some extent? It might be hard.
Exactly.
But there are zombies out there. We know it, right?
Anyone who wants to go around wearing a zombie buster T-shirt, to Ghostbuster music, that's going to be the big theme of this year.